Good morning, everyone, and welcome to this edition of The Market. I'm Avan Dabash, with me Anisha Jain as well as Nikunj Dalmia. And well, for the equity markets, you've got a pretty flat close in yesterday's trading day. So safe to say that we've been confined to a very tight range for the past many trading days. 19,600 to 19,850 is what we've been in for quite some time. FII as well, the net sell figure continues, 4 straight days on the trot at that. And the small cap index, well, you did see a slight degree of outperformance kicking in. This morning as well, we're waking up to cues where you've got, for the most part, the Asian markets that are piggybacking on weak cues from the US, so it seems to be indications of red. Nikunj, is there a sense coming in that while we will continue to remain in this tight range, that 19,800 as well is likely to be that spot where we'll keep seeing resistance?
See, Avan, you are in a range, and then you perhaps have to just acknowledge that and admit that you are in a range. And let's look at the setup here. Now, when I say range, it's a very, very narrow range. Last 8 sessions, Sunday, Monday, Tuesday, Wednesday, Thursday, Friday, 8 sessions, 2 weeks almost. You've just been in a 250-point range. Now, a variety of factors are at play here, but the net impact is that even though global markets have been in a rara mode, Nifty has, or benchmark indices really have been in a range. The long positions, and I'm talking about the FNO long positions, the data which we use as FI long short portfolio, that also seems to be tilting more in favor of where short rather than long, which means, just to explain that data, looking at this data, it is visible and it is apparent that the long positions are reducing and hedging, and short positions are going higher. So the institutional activity is telling you that nobody is betting on any kind of a reversal, nobody is betting on any kind of a sell-off, but maybe it's time to take some chips off the table or time to start buying that insurance. So we are in that phase of the market where you have 2 options: take some profits off the table or start buying some insurance. And unfortunately today we'll talk about the global markets. That support in the global market, which in a sense has been the real tailwind frankly in my book, that also seems to be just waning away slightly. So it would be I would say it will not be a difficult Wednesday morning, but it would be a very thanda market, so to speak.
We'll be in a limbo, I guess.
Yeah, it'll be a reality check of sorts that will come into the picture today. And as you pointed out, the Asian markets this morning aren't also doing much. There's a cut of 1 to 1.5% across the board. The Nikkei is down 1.5%. Kospi 2 is coming lower. And all of that because there is a news flow that has happened overnight, which is very, very important and critical for the global markets. And that's the fact that Fitch has downgraded the US sovereign rating. They've downgraded the rating to AA plus versus AAA earlier. Remember, the last time we had seen a downgrade come in for the US sovereign rating was back in 2011 after the debt discussions were happening there. S&P had cut the rating to AA plus, and now Fitch has also gone ahead and cut the rating. For now, Moody's stands at AAA, but there is a rising risk that there might be a cut coming in from Moody's as well. Now, what are the reasons that Fitch has given? Well, they talk about fiscal deterioration, they talk about the growing debt burden, as well as the fact that all of these discussions which have happened over the last 2 to 3 months has eroded the fiscal confidence that the world and the market had in US as a sovereign. Of course, no surprise that US Treasury Secretary Janet Yellen is disputing all of that and saying that US economy still continues to be very strong. But a very interesting move happening there, Nikunj. And of course, there is commentary coming in from Mohammad El-Erian, etc. as well, saying that the vast majority of economists and market analysts looking at this are likely to be equally perplexed by the reasons cited as well as citing. And overall, the announcement is much likely to be dismissed than having a lasting disruptive impact on the US economy. But this is something we have been discussing, right? India stands at a very low rating when our fiscal is improving, fiscal strength. And what was happening with UK, what's happening with US now, and they still had AAA ratings.
So realistically, this was long overdue.
Yeah.
Nobody's surprised with what they're essentially saying. Now, will this have a very strong impact on the way how things are going to move in terms of the near-term stability of the financial market? I doubt it very much. Of course, you will get a rebuttal from the US Treasury Department, which is what Janet Yellen has immediately indicated. global commentators will not be very happy with the reasons which are cited, but what Fitch is saying, I think, is pretty much the obvious, which is that post the extension of the debt ceiling, the the balance sheet of the US government has only expanded. Bond yields are rising. They are going to be running into a rough weather in terms of servicing this huge debt. But that's like yesterday's story. So in terms of a market positioning, I don't think this has come out as a nasty surprise. This is not like, oh, world's going to change because of this downgrade. But incrementally, I guess now rating agencies, which I've always maintained have had a slightly, they had a bent towards what the developed economies have done. I guess now they are also realizing that you got to start calling spade a spade. So nothing new, frankly, if you ask me, but this is something which is unlikely to have a very major impact in terms of the financial market setting. So you look at Asia this morning. It is not that Asia is falling flat. It is not that US markets have completely gone, belly up in the US futures market. So it will have a sentimental rub-off. I don't think anything more than that. Anurag Singh is ready. Good morning, Anurag.
Morning, Nikunj.
Do you agree with this analysis? Long overdue, but unlikely to have a serious impact.
Absolutely, Nikunj. I think we got to appreciate that, after a long time, some rating agency has taken the courage to really call a spade, right? And I think their bigger point is that even the last 20 years, the way the government has been governing, of course, there have been last minute deals, but if you see the overall political climate has been deteriorating. And I think that's kind of well acknowledged. The other point, Nikunj, I think they highlight, and which is very clear, and almost everybody is talking about it, is that the government can't sustain this level of spending on social security, Medicare, Medicaid. Together, these two components consume almost like 55% of the budget of US government. And at some point, government will have to do the tough talk. Nobody's willing to do that. So barely they just heckle over some 700-800 billion, whereas the entire 5 trillion, nobody is willing to just kind of talk about that. So I think these kind of news really puts the government in a corner that, look, you don't have a printing machine and you really got to take the fiscal responsibility and take some control on that.
Why is there no panic? I mean, a rating agency, and which is a very well rating agency, which, like you said, finally had the courage to endorse the obvious. But there is no panic. Bond markets have not rallied, have not sold off. Equity markets in Asia, even if I look at US futures, they are not down in a meaningful manner. So do you think from a market standpoint, this news is yesterday's story, not tomorrow's trend?
Yeah, so I think market, because the assumption is that as of now, this news will probably come and pass. And, of course, there is an agreement. So the government has a free runway till 35 trillion. But I think market they might have bigger worries, and market is currently they don't want to listen to anything, right? Not even bad results. But at some point, I think within the next 6 months, this worry, and we'll have to see what Chair Powell will have to speak. I think they'll have to start thinking of, how will this debt burden be contained? Will the government inflate it away, or, will the Federal Reserve will have to hold higher for longer? And I think that debate will have to really give the markets a reality check. So hard to say how exactly markets will react, but looks like they are willing to just roll it over for now.
Okay, and how is it that you're looking at the concerns down the line, given the fact that there have been tax cuts, the new spending initiatives, that is what Fitch is alluding to, that has led to the downgrade this time around. In the medium term, what are the challenges that you anticipate for the US economy?
So Avan, the near-term challenges are only this. One is that in this decade, will we finally put a lid on inflation and then move on? Like, if we are able to do that, then I think the next 10-15 years look very rosy. But the counter point to this is that, if there is this huge debt and government never pays the debt and it always inflates it away, I keep saying this term because this is a notorious term. The one segment of the market thinks that, inflation is here to stay and it will bother us time and again. And if Fed stays and, even for a couple of years at these rates, it is hard to say. My sense, Avan, I would say, again, we are in the market, so we have to take a clear call. We are, people like me are in a minority now, but I think we certainly feel that the inflation is really stuck in the wages and it is very persistent. We will see, I think this month's number should come a little higher. And I think if the Fed bounces back again on the same inflation fighting path, I think it's going to be a little difficult for the market. So that's where, Avan, the whole debate is. We'll come to know who comes out on the right side of this. But this is also very sure that market should not be running in a hurry. There's no obvious trigger to run up in a hurry, right? We have seen all the results, and despite earnings downgrades and lower top line, the markets are just running away as if there's no tomorrow.
Oh, well, yes, the markets are running away, and I take your point when you talk about inflation as well. And thank you so much for joining us and talking to us about that. So a bit of a surprising move coming in from Fitch, but maybe a bit delayed as well, because this is something which has been talked about, not a big surprise. But shifting focus back to what's happening back home, and it was all about the auto sales data yesterday. We were watching out for numbers, and it wasn't a very impressive set from the likes of Bajaj Auto. Eicher Motors also disappointed on the Royal Enfield numbers. Escorts was too a little below expectation, but what managed to surprise us was M&M as well as Ashok Leyland. But Nikunj, looking at the kind of GST collections we have been getting, looking at how the monsoon is panning out, do you think this is likely to get better? Because this month again, it was a bit of a sluggish data that we got, nothing too impressive, but is it likely to improve from here on?
Anisha, I think you have to understand that there are some major shifts in the auto sector, and those major shifts in a sense are benefiting some companies disproportionately, and and it is actually hitting companies also disproportionately. Let's look at the aggregate picture. The aggregate picture is that the passenger vehicle category, which is the PV category, is growing at only 4 to 5%. It's even growing below the GDP. But if you are in the SUV business, well, this is boom time for you, and these companies are clearly making hay when the sun shines. So then it really is a function of which category and which particular quota are you servicing. Then CV is in a definite upturn, 9 to 11% growth. It is visible, and that is what we are also getting a sense when you do your basic ground check, whether it is CV, whether it is LCV. Two-wheeler, I guess, is disproportionately divided. Disproportionately divided in the sense where Eicher and TVS, they both have come out with good set of numbers. Hero MotoCorp and Bajaj, they continue to suffer. I don't think we've seen any kind of an impact of the Harley new launch or the Harley Hero new launch, at least on the Eicher dispatch numbers. And TVS, despite not really commanding a very formidable kind of a product portfolio, is still gaining market share and also is gaining an export. So you cannot paint the entire sector with the same brush. But frankly, if you ask me, I don't think this sector is in a boom per se. If the sector is not in a boom per se, the underlying auto stocks are unlikely to gain further. It's all about relative and absolute. And what is in the price? Auto stocks have had a clean run, and these stocks have done exceptionally well. Based on these numbers and the management commentary we've got from earnings so far, I guess the move now is going to be not linear, it's going to be very, very selective. So the sector is now getting completely fractured. There was a time all two-wheelers did well. There was a time when all passenger car vehicle companies did well. That is not the case. Two-wheeler market on an aggregate basis, look at Eicher numbers and look at the numbers from Hero MotoCorp. I mean, trying to compare chalk and cheese here.
Yep, so it is very selective when it comes to the overall auto sector, but there have been new launches as well in the utility vehicle segment, and that maybe has lent a helping hand, at least when it comes to select companies in the passenger vehicle space. All right, auto aside, let's discuss markets, let's discuss levels. Kunal Bothra and Naresh Marani are here for just that. And Kunal, we were just discussing earlier this morning, yes, it's a range, a very tight range at that, but will 19,800 continue to remain a stumbling block for the markets?
Good morning, Avan. So I think it's 19,950 to be precise on the index, 950 to 20,000. That's the range where the index has taken multiple resistance. And I think on the support side, 90,500, 520 is actually a very strong support. It also coincides with the short-term key 20-day moving average for the Nifty, which the index has been protecting over the last 3 or 4 months of this very strong price uptrend or or a bull market as such for the index. So I think on the way down, we would probably take a halt at the 19,500, 520 mark. And we are dabbling into this 500 point range for the last, I think, 1 week. We've done this previously as well, where the index has remained sideways for a couple of weeks before it gains momentum and then tries to break out on the upside. So we can probably expect this time around very similar kind of a trend. But I think the evidence would be if the index breaks below the 90,500 mark is where we expect a change of trend. As of now, we would expect that this consolidation would continue for the index.
Okay, so that was about Nifty. 19,500 is that line in the sand. But Naresh, what do you make of the strength that we have been seeing time and again in the broader markets? That's been outperforming despite the weakness that we are seeing at the headline level. And on the other hand, the banking index has been sluggish.
So if we look at it, the bank index is interestingly poised because what has happened is most of the names, heavyweights, are not really making any trending moves. You have HDFC Bank stuck at the same place around that 1650, 1700 mark. Then you have ICICI Bank stuck at 990. The previous high for the stock was at 960 odd levels. So no follow-up momentum. SBI keeps coming to that 620 mark, but is not able to break out clearly. So that and then you have Kotak Mahindra Bank, which is not going anywhere, drifted lower and then again going sideways. So out here, the case is the trend is still up. A lot of stocks have, say, ICICI Bank has broken out and holding around that point. Axis Bank also is not breaking down. So overall, the index is stuck in a range. Same is the case with the Nifty. At least in the Nifty, we keep seeing some rotations in the smaller weights out there. So overall, the views, we are stuck in a band 19,500 to 20,000. At the same time, what we are seeing is the mid-cap indices, the small-cap indices continue to outperform. Yesterday also, we saw a fresh new all-time high on the small-cap index. So the momentum is still strong. But the point is, when we start diverging a bit from the Nifty, the small-cap starts outperforming on a big margin, one needs to get alert that there could be some bit of a pause even in the broader markets going forward. As of now, no indications of a change, but will remain alert.
All right, no indications of a change as of now, but let's find out the stock-specific calls. Zen and Kunal, one buy, one sell.
Well, yes, and going with the fresh tilt of change in the market, I think it's better to go with a mixed set of strategy. So first one is about IDFC First Bank, and the reason for picking up this stock was even on a day like yesterday, where most of the banking stocks as well as the indices were going through a bit of a correction, the stock managed to hold its foot above that 87 mark. So would suggest a buy with a short-term target of 92 on IDFC First Bank. Stop loss could be kept at 86. NTPC, a stock which has actually done exceptionally well in the last 3-4 days, seems to be coming back into an overbought territory on the chart. So would suggest an intraday sell on NTPC, targets of 218, stop loss at 228.
Okay, a buy and a sell coming in from Kunal, but it's a buy and sell from Naresh as well.
Yeah, so going more with a neutral approach. First is a buy on United Breweries Limited, UBL. The stock gave a breakout above 1540, 1550 levels. Went up and then saw a gap down post the quarterly numbers. The stock has now crossed the highs of that day, so the gap down has been recovered. And now a fresh trend is coming up. So range breakout done. Good follow-up momentum in the last 2 sessions. Expecting this to continue towards a target price of 1800, stop loss at 1560. Second is a sell on Polycab. The stock saw a massive run over the last few months. In the short term, it has kind of tried making a double top around that 4900 mark. And yesterday was the first reversal candle in a meaningful way. So keeping a strict stop loss at 4690, a target price of 4450 on the downside.
Okay, so those are the top recommendations coming in from our charters. But just wanted to come back to the point that even Naresh was making, Nikunj, and that was about how one needs to be alert what's happening in the broader markets. Yesterday as well, we saw all those smaller stocks rising, the likes of Suzlon, etc. Gives you a bit of nervous feeling?
It's not the broader market. I guess that's a market which is an avoidable market. I mean, broader market is you're talking about mid-cap and small cap, but there are pockets in the market which are clearly patronized by not even HNI traders. They're really patronized by weak trade, hand-on-heart traders and by really retail traders here. Now, if you look at yesterday's setup, it's not that markets have done something exceptionally strong in last 7-8 days. At least Nifty has been in a range, the point which we are trying to bring out. But look at the move in some of the small cap power stocks here. Orient Green up 25%, 25%. JP Power. HCC is not power, I mean it's in construction. Ratan India is 7% up. Rama Steel, again it's not power, but it's again a small cap stock. And REL Power, I don't track this one. Reliance Power, Reliance Power, sorry. So you have to stop tracking even the trig now.
Yeah.
And then you got Suzlon. Now you got to ask yourself why? What has changed which really warrants this kind of an chunky move? And then if you see the volume action here, the volume action is much higher than the 5-day average, much lower in terms of delivery. So it is not a very look at the price action here. All the volume in some of these stocks are double to nearly 3 times more than the 5-day or the 10-day average, and the delivery is coming down. So you just ask yourself and say, okay, I mean, when the tail starts wagging the dog, is it a good sign? I'll say it again, when the tail starts wagging the dog, you got to be just careful. And I think the tail has started wagging the dog in this case. Right, Kunal? Tail is wagging the dog.
Yeah, there are many small cap names, many speculative stocks to speak, so they've actually started to pop up quite.
When this happens, will market peak, or I'm just trying to connect 2 and 2 here?
No,
or are you using benefit of hindsight?
So both of them happen. So the market starts. So what happens is, Nikunj, at the end of a market correction, or at the start rather of a market correction, and at an end of a trend.
2 दिन तो market range bound end कहाँ हो गया correction?
No. I'm saying technically at the end of a rally or a start of a correction, traders are more left out with stocks which are high beta in nature. So you start off. Buying those HDFC banks and ICICI Bank in your portfolios, but then at the end of the trend, you are actually left out with those high beta and speculative names. So that's the catch, which is very, very important to understand this time.
Just be a bit careful here, folks. That's what we are saying. Ultimately, it's a call which every individual has to take based on the risk. But we are simply flagging off based on our understanding and our experience that when the tail starts wagging the dog, you would ask yourself, why? I've not used the word Humpty Dumpty, but some of these stocks are now reaching that Humpty Dumpty level. I mean, we're talking this terminology, Avan, that markets were adding muscle. When you see an instance like this, I'll have to say that markets have started adding fat. And fat makes you obese, never healthy.
Okay, that's how you should look at the move in some of these stocks. But let's move on then, and Samit's here in our studios to discuss 2 stocks. Let's begin with Interglobe Aviation. All eyes on this one, Samit, as we're watching out for the numbers. I guess 3 factors. One, we're expecting healthy numbers. Is the promoter stake sale going to be an overhang? And of course, go first shutdown. That's going to be a big bolster.
Well, for Indigo, if you see, it seems like all the positive things were accumulated in the first quarter of FY24. Passenger traffic was higher, passenger load factors were higher, yields which measure average fare, that was also on the uptrend, while oil prices were on the lower side. Now, if you see the estimated profit for the first quarter, that is expected to come in at close to 2,300 crore rupees. Now, this number of 2,300 crore is more than the highest ever annual profit that the company had reported back in FY18 of close to 2,200 crore rupees. So that's the kind of strong or blockbuster number expected from Indigo in the first quarter. Now, if you see the average daily air traffic, that was up nearly 2% on a sequential basis. Passenger load factors, which is a measure of capacity utilization, that was high by around 600 basis points. Yields, which measure average fare per passenger per kilometer, that was up nearly 6%, while oil prices was down nearly 21% on a sequential basis. Now, oil is the major cost for an airline company, and that being 21% down will definitely boost the EBITDA, or the EBITDA, that is the operating profit of an airline company, and its net profit as well. But as you were mentioning, there are concerns given the fact that Q2 has started off weak. Air traffic has been down for 2 consecutive months that we are trending, that we are seeing right now. Yesterday we also checked the airfares. Airfares have also come down on all the top 20 routes in India, and also there is another overhang on Indigo share price, and that will happen after 2 days post the result, and that is the promoter stake sale. Now, there have been market reports that Rakesh Gangwal is looking to sell a stake worth nearly $1 billion, but that will most likely happen 2 days after the company has announced its result.
Very interesting in terms of the stock move as well, because if you look at the YTD basis, the stock is up a good 25-30%, but 1 month it's been pretty much flat, and I think the overhang is what you talked about, the supply pressure coming in. But in wake of that supply pressure, Nikunj, what do you think is likely to be the case for Interglobe Aviation? Do you think after this, let's say 1 week, 2 week of consolidation, it's going to start rallying again?
Nisha, look, crude is moving higher, and there is no way you can make a case that airline stocks will move higher if crude is moving higher, because that is something which changes your dynamics immediately in the short term. But my view is very simple. I guess the challenge for the airline sector has been that you've never had too many well-run companies in India. I think Indigo has demonstrated the ability to go through thick and thin. Whether it was COVID or whether it was that uptick in crude, when they were able to manage their balance sheet without destroying it when crude went to $130. So the point I'm trying to bring out here is that while optically there are no triggers in terms of a short-term move for Indigo, and the promoter stake sale, what Somit pointed out, I think is going to create more supply. But I frankly feel that Indigo now really needs to be looked with a very different prism from next 2 or 3 years, because capacity addition is real. The whole migration of Indians now moving to air travel as a preferred mode, new airports adding up. So the macros I think are strong, and Air India is not going to be disruptive in terms of creating a price war. I mean, Air India's entry is not going to be creating a geo-like situation, if I may use that terminology. So my sense is that bulk of the re-rating in Indigo in terms of trigger, what Somit said, I think that's behind us. But I think it'll be naive to sell the stock, given that for me, I think Indigo, even though it represents a cyclical business, it is a bet on indirect consumption. I mean, there was a time when you were doing an air travel, it was considered to be luxury. I think now it is moving to necessity. That's my limited point. So the big picture analysis in my book, I think, is still interesting.
Okay, so forget about the near terms ups and downs. The long-term story is pretty much okay, but don't expect a massive re-rating as well, given crude prices have become very, very volatile. But that was about the aviation sector. A lot is happening in the cement space as well. And this morning itself, Somit, we heard the news that Ambuja Cements is likely to buy out the majority in Sanghi Industries.
Well, yes, that this Sanghi Industries has been on block for a very long time. Earlier, there were reports that Shree Cement might go ahead and acquire Sanghi Industries, but today's Reuters report says that it will be Ambuja who will be acquiring this company. However, there has been no formal announcement so far. Now, why would Ambuja be interested in Sanghi? Now, Sanghi has India's largest limestone reserve. So, how the process works is you heat limestone, you get clinker, you grind the clinker, you get cement. So, a company with highest limestone reserve has that at least the potential to increase capacity or to give more or to do more production in the industry. Now, what valuations, what we are understanding at this moment is that Sanghi Industries has a capacity of 6.1 MT of cement, and they are looking to acquire it for around 6,000 rupees. That is the EV valuation coming in. Now, at 6,000 crore, the EV per ton comes at around $120. And this is largely at par with what Adani Group did while they acquired ACC. Now, they acquired ACC at around 120, 130. Ambuja acquisition was a bit on the expensive side, around 170 to 180 dollar per metric ton. Now, along with the 6.1 MT, if you see, Sanghi Industries also has a clinker capacity of 6.6. Now, usually when clinker capacities are higher, there's a chance or a scope for a cement company to expand its cement capacity as well. So, what analysts are saying is that Ambuja might go ahead and increase the cement capacity by around 2 MT more, and then the cost of acquisition for the company, for Adani Group, would actually come down to around 100 MT per ton. But it's the limestone reserves that is the most attractive asset of Sanghi Industries, and why Ambuja or Adani Group might be interested in acquiring the company.
So, but the Sanghi acquisition would be at a discount to what the market average is in terms of EV per ton, right?
Well, yes, if you see the top 5 companies that have been trading it, it will definitely be at a discount, because the operations were a bit hurt because of working capital issues. There are debt issues in the company, 1,800 crore of debt. That is what we are understanding in Sanghi Industries. So, given that all this picture,
it will be at a discount. Right?
It will be at a discount. Obviously, it is also not a large player. But current market price, if you see current value, current market cap of the company Sanghi Industries, it's close to 2,500 crore rupees. The EV comes at around 4,000. So, given the current market value, it will be at a premium, but compared to its larger peers, obviously the EV per ton comes at a discount.
And the other way I look at it, Anisha, is that look, Adani's are acquiring something worth 6,000 crore, roughly. Now, for a group where there were debt issues beginning of the year, we are forgetting that. I mean, you will only acquire something when you are confident of servicing your debt. You may be in a, it doesn't matter if there are too many distressed assets available. If you don't have the ability to service that acquired debt, you're not going to buy it. So while you may say that in good times you may want to make an acquisition, it's only when you're confident of your cash flows and when you've gone through terrible meeting in terms of your debt profile and question marks were being raised, you are going and making an asset acquisition, which means strategically you feel that you can make the acquisition, service the acquisition. B, cement is where your serious focus now is going to be there. So There are two ways of looking at it. I mean, there was no urgency, but if you're going ahead with it because you're confident of servicing the debt, and that also speaks that Adani is now really going to be changing the rules of the cement sector.
Very interesting in terms of what's happening in the entire cement space. And yes, interesting to point out that, despite the kind of issues the Adani Group has seen since the start of the year, they're going ahead with making this acquisition. And what reports are suggesting that this announcement can come today itself, because Ambuja has a meeting today to discuss their earnings as well. But, I'm not sure if you've done this analysis, Somit, but what does it mean for the shareholders of Sanghi Industries in terms of the equity value? Is there going to be a big premium, not in terms of the multiples of the enterprise value, but just the share price?
So obviously, given the fact that they are looking to acquire the entire promoter stake, there would be an open offer for the public shareholders as well. And given that it is, at least at this moment, what we're understanding is that the EV is at a premium to the current market value. So there could be some premium for the minority shareholders as well.
Okay, so that was about the cement sector, but the most heated space right now is what's happening with respect to manufacturing. So let's welcome on board Mr. JS Gujral, the MD at Sirma SGS Technology, joining us to talk to us about their business, because they've made a recent acquisition as well. Mr. Gujral, hi, good morning. Thank you so much for making time and speaking with us. Well, you're forayed into the electronic medical devices segment with this latest acquisition coming in. What's the strategy and the opportunity size that you see here?
You see, we have been evaluating inorganic acquisitions, and the principles guiding these inorganic acquisitions are primarily A, if it fulfills a gap in my product offering, or it gives me certain regulatory approval which have a long gestation period. Medical, apart from defense, is one of the growing sectors around the globe, especially in India. And we had some presence in healthcare through our RFID business, but very little in the EMS business. Now, with the acquisition of majority stake in JDHL, we get access to the US, Europe, Australia, Brazil markets. And they have about 18 products which have been approved by the FDA. The facilities are approved by the requisite certifying agencies. And we believe that with the global reach of Sirma SGS, the management bandwidth of Sirma SGS would be able to leverage the technical depth, the R&D strength of JDHL, and the two put together would be a win-win situation.
All right, so Mr. Gujral, by when will this acquisition be revenue and margin accretive, and how much do you see it adding to your top line?
You see, last year they did 160 crores. If I take the last year figure, it's a 160 crore accretive to the top line, and with about 58, 59 crores of EBITDA. Now, even if this year they grow at 20, 25, 30% or around that range, so I expect the revenues this year to be in the vicinity of between 180 to 200 crores and EBITDA of about 35%, 33, 35%, which adds up to about 65, 70 crores. So one factor which we should always keep in mind, that since we are into a product business in JDHL, the revenue growth would come once more products get approved. The existing products would have a secular growth of 15, 20, 25%. But once more products are added to the portfolio, whichever period or year they come in, that will see a spike in the revenues. And we have some significant products in the approval stage at JDHL. We would be able to bring in our expertise as a top-notch EMS company. So the operating leverages, the efficiencies of the plant, because JDHL is primarily a R&D organization and based on sort of focused on technology. So with our core competency of efficient, cost-competitive manufacturing, I think it will be a win-win situation, as I said earlier.
Fair enough, but Mr. Gujral, it was a bit of a mixed performance this time around. There was very good revenue growth when it comes to your consumer segment, but health and IT were a bit sluggish. Talk to us about what is impacting the revenue for the high-margin health business.
You see, we have had a good quarter. We have grown significantly in top line, bottom line, everything. One aberration this quarter which happened was the healthcare, which had picked up in the fourth quarter of 22-23. It was very strong in Q1 of 22-23. Second and third quarters were muted. The fourth quarter, it had picked up. Unfortunately, the pickup of the fourth quarter couldn't carry into the first quarter of Q3, Q4, 23-24, and it is now spilled over to second quarter. Just to give you a reference of the figures, the healthcare business accounted for approximately 55 crores in Q1 of 22-23, 45 crores in Q4 of 22-23, and only 15 crores, less than 15 crores in Q1 of 23-24. So we see almost a 40 crore dip vis-a-vis Q1 and a 30 crore dip vis-a-vis Q4. And this is a very high margin business. Here, the gross material margins are in the range of about 40-45%. So if my turnovers in the healthcare have come down by, say, 40 crores compared to Q1 of 22-23, it's a direct hit of about 16-17 crores on my EBITDA margins.
So given the one-off in the health of impacting this margin this quarter, when can we expect your margins to come back to that range of 11 to 12%?
See, we have been maintaining double-digit EBITDA. That's been our sustained call right from last year. And I think if the healthcare business comes up to its expected level, we should be there at double-digit EBITDA. I don't count the chickens before they are hatched. So all the operating leverages and everything which will come will count when they come.
Okay, not counting the chickens before they hatch, maintaining a bit of a conservative view, but at least double-digit margin will be maintained. But, you know, large part of your revenue also comes from exports, almost 25-30%. How's the demand shaping up in the export segment?
Exports have grown this year also in the first quarter. And the EMS exports were predominantly to the EU. The RFID exports were both to the EU and America. As we speak, we have won a significant contract and we'll be starting the trial production later part of this year from a global multinational based out of America, which is for utility metering. So utility metering would include metering systems for water, gas, and electricity. So America business would add a leg to the export business because our current EMS exports to America are pretty low. And with this one customer coming in and 2-3 other customers in the pipeline, we expect the export business also to grow at a decent pace. Though the markets are not growing, it's only acquisition of a new business from competition or from China Plus, which is fueling the growth even in the export markets.
And given the new foray, the client additions and the growth in exports, what kind of revenue target have you set for FY24?
Still maintain the guidance which we had shared with all the stakeholders beginning of the year. That was the organic revenue targets and the EBITDA targets. We still maintain that. And the JDHL acquisition is accretive both to the top line and the bottom line. It will be more to the bottom line because of its higher EBITDA. And on the top line, it would be maybe 5-7% accretive to my turnovers or 6-7% on my turnovers. But on the bottom line, it would be sort of EBITDA margins would get up decent accretion. Now, when we had set out this year, one of the targets, apart from the revenues, margins and all that, was to bring down to a working capital cycle, which was hovering at about 96 days. And I'm pleased to share that for the quarter ended June, this has been brought down to 74 days. The target was to bring it to below 80 days or around 80 days. We are currently sitting at a net working capital cycle of 74 days. So that's a very good job done by the team in managing the cash flows. As a result of this, for the quarter ended June, we have a OCF to EBITDA ratio of 50%.
No, Mr. Gujral, you said the entire context and you're maintaining the guidance for the full year. But what is the revenue target you have in mind that you've communicated to your stakeholders for the next 1 to 2 years?
See, I had said that we'll grow at a rate better than the industry. Industry is expected to grow at about 35%. So I think you can derive the figures. I would not like to commit a forward-looking statement. But if the industry grows at 35%, we would definitely grow at the industry rate or more than the industry rate. So we did about 2,000 crores last year. So that will give you an indication of what the organic growth would be. The JDHL acquisition would be additional to the top line and the bottom line.
All right, interesting. Thanks so much for giving us all of those details. That's the management then of Sirma SGS. Double-digit margins, that's what they're confident of, and they are looking at some big orders as well and smart customers as well coming in from the export markets. Time for a very short break. Be right back. Lots more lined up.
Auto sales data, that was the key talking point, and Maruti disappointed a bit with the kind of numbers it had reported. But let's go across to Mr. Shashank Srivastav, the Senior Executive Officer, Marketing and Sales, Maruti Suzuki, to try and get a better sense of what's likely to happen in the coming months. Mr. Srivastav, hi, thank you so much for making time and speaking with ET Now. Well, you sold 1.8 lakh units in the month of July. Going ahead, can we expect the sales number to continue? What are you hearing in terms of the moderation of demand and the clamor around it?
So yes, you can expect this level of production and numbers to continue, especially when we see the festival season kicking in from the end of this month in Kerala and going forward, spreading to the other parts of the country. First, the western part with the Ganesh Chaturthi and Janmashtami, and the northern part later on, and the eastern part with the Diwali and the Durga Puja. So yes, I would expect these numbers to continue going forward. On the other question of retail being a little less thing, actually, if you see, the volumes have been pretty good. We have had the highest ever April, the highest ever May, the highest ever June, the highest ever July. So in terms of absolute volumes, I think we have seen some really good set of numbers in the industry. However, if you are referring to the growth rate, for example, in July was about 3%, and in June it was about 2.1%. That seems to have come down, and I think the reason is that the base effect has started coming in. Last year, quarter two was a very large one. In fact, the highest ever quarter in our history of Indian passenger vehicle was last year in Q2. And the highest monthly sale was also the highest monthly, and the third highest monthly sale also were in the Q2 of last year. So on that significant large base, I think growth figures you might see a little muted. But in terms of the absolute numbers, yes, the numbers seem quite good in the industry.
So the absolute numbers will be fine, but the growth rate might look a bit subdued because of the high base. But to maintain this growth momentum, have you been indulging in higher discounts?
No, I think my expectation, while of course the market forces will decide that those levels, but my expectation is that they will not go up from here. Because one of the big things which happened in July on and expected to continue is that the semiconductor issue has become a little less serious, and we have seen much more normalized production in July. And what that helps us is that it enables us to modulate our production in those models where so far we have been producing more than what the demand was. And in other models where we were producing less than what the demand was. So we can produce, when we can produce all models, then obviously we can modulate our production as well. And therefore, I would expect discount levels not to go up from the levels that we have seen in the recent past for small cars.
The discounts are not going to inch higher, but Shashank, you have big plans to lead the SUV segment. Where do you see the market share stabilizing for Maruti by, let's say, FY24 and in the SUV segment?
We introduced these four SUVs that we now have. We have the Vitara, we have the Brezza, we have the Fronx, and we also have the Jimny. And I'm happy to say that Maruti Suzuki became the number one SUV manufacturer for the month of July. So in July, we could do almost about 42,000 plus SUVs, whereas our next competitor in the industry was around 36,000. So our market share in SUV in July was about 25%. If you compare it with last full year, financial year, market share was 12.1%. So we are sort of making good progress in terms of market share gains in SUV segment, and also in our stated objective to be the number one SUV manufacturer for the financial year. So we have made some good progress. We were in Q1, our market share was about 20% or so. It has in July went up to 25. Last year it was 12.1. Even in Q4 of last year, it was about 16.2%. We are making good progress, and hopefully we will continue to do so in the balance part of the year as well.
Okay, Shashank, on that note, we'll let you go. Appreciate you joining us on the show, and all the best for the coming months and quarters. But let's take a look at what is happening with Tata Chemicals. That company is in focus today because the company has revised the soda ash prices yet again, and they've cut it by almost 5%. Lisa is joining us with more details. Lisa, this is not the first time we have been hearing it, right? They've already cut it 4 to 5 times since the start of this year, but a sharpish cut coming in yet again.
Right, Anisha. So Tata Chemicals, they came out with a notification, and this is on a downward revision in their soda ash prices. This is for their light soda ash prices, and it has been cut downwards by 1,800 per metric ton. Well, for Karnataka, for regions like Karnataka, Maharashtra, Bihar, Jharkhand, the price stands at around 29,800 per metric ton, and this entails a downward revision of 5.7%. And for the rest of India, it is at around 30,500 metric ton, which is a downward revision of around 5.6%. Now, do note that this is not, the last revision was taken way back on 14th June, where a 6.8% revision price cut was seen, and Tata Chemicals had seen a sharp cut in their stock price movement also. Now, since April, the China prices has been trending downwards, and this is because of demand availability, the lowering of fuel prices. All this has led to China prices also coming down. It has come down to $250 metric ton from 350 levels, which was seen that time. So this has also flown in for the domestic prices as well, because since April, this is the 4th consecutive cut that Tata Chemicals has taken, and together it comes to a cumulative cut of around 20%. Now, what are the analysts saying? That they believe that the soda ash price revision will impact the margin, which shall normalize in the coming quarter for Tata Chemical domestic segment as well as for GHCL. So do keep an eye on Tata Chemicals today.
GHCL and Tata Chemicals, well. For the chemical companies, not everything is looking hunky-dory. Himang Jani, good morning.
Good morning, Nikunj. I think when you look at the chemical companies,
I didn't ask you a question. I didn't ask you a question only.
So Nikunj, you took a long pause, so it was difficult for me to figure out.
I wanted to just say good morning and hear a good morning well back. We don't have to talk markets every time. You're getting too serious on the show, yaar. Naresh, smile karo, Naresh. Chalo, come on. Okay, let's start with chemicals now that you've started.
So, what's the question, Nikunj?
Nice. Okay, I want to start with something very basic. How should one understand the Fitch impact on Indian markets? Can we ignore it?
I think, Nikunj, the fact that we've done so well in the last, let's say from April onwards, we've done exceedingly well in the index level, broader markets. So, if you see some, let's say negative data points on the global markets, or, some sort of a correction somewhere, I don't think we should really bother too much. I think if you look at the earnings season so far, it's been progressing reasonably well. Almost about 33 Nifty companies have delivered numbers, and by and large, at the aggregate level, things are looking decent. Monsoon is progressing well. So not too worried about, small things here and there. I think the broader trend for our market is quite positive.
Naresh, can you comment on what price action we've seen in some of the smaller power stocks? Because that's one space where, like Kunal was also, sharing that it's a space where when you see price action, it is a clear indication that market has started adding fat, not muscle.
So the fact is, the problem is with power sector, people have not been as bullish. But if we realize this sector did not do well from 2007 to 2000, almost 21, 22. So the sector was in doldrums. Even today, on a non-adjusted basis, the largest company like NTPC has not crossed 2007 highs. The smaller names which have recently broken out, something like a NHPC, the stock was at 38 rupees when it got, say, IPO'd back in 2009. And today the stock is at 51 rupees, 52 rupees. So the returns have been terrible. In the near term, just because it's gone up 15-20%, it looks a little overdone. Same way, a Suzlon is still down a lot of it from the top. So the smaller names are just coming out of a multi-year period of no returns to terrible returns. If you look at it, Tata Power also, the other name which has gone sideways for the last year and a half. JSW Energy has corrected from the top, wherein if you could look at it, the stock was at 400 in 2021. Even today, it is at sub 300 levels. So they are still being sideways. So the smaller names, it's just that the pace has been large for SGV and NHPC. And these are stocks which generally did not used to move at a fast clip. So NTPC, for example, has gone from 197 to 225 in less than 4 sessions. This has not been the general tendency, but that is how trends start. Continue to remain bullish on the whole sector. NHPC still looks interesting. Tata Power has finally given a breakout on dips. That looks interesting. So like the whole sector as such, the smaller names as well as the larger names.
Okay, fair enough. Meantime, Hemang, I don't know if you've gone to the theatres and seen Barbie, Oppenheimer, or even our very own Alia Bhatt and Ranveer Starro, but do you think that basically all of these movies will give that fresh lease of life to a lot of the, multiplex companies that have been struggling for a long time?
Well, I think, Avan, though I haven't been able to, catch up on any of these movies, I looked at the, PVR numbers, and what's really, coming out very clearly is that there is some degree of revival on a quarter-on-quarter basis. But still the overall numbers and the comfort is not that great. Hardly about 2-3% kind of an uptick on the ticketing side, and our sense is that the pipeline of the new content and the kind of things which have happened in terms of the cost control and all, and the kind of cash burn that they have seen, that is quite huge. So I think though you might get a little positive on it because of the quarter-on-quarter performance or because some movies doing well, on an overall basis, I think this space will remain a little subdued.
Okay, the overall space might remain subdued, but we were just discussing the aviation sector also, Hemang, and this entire urban consumption, just a corollary of what you were talking about, PVR Inox as well, and the entire hospitality industry, hotels, etc. Do you still see our upside, or do you think the best is already priced in?
Comes to Anisha, the hospitality, things are looking much better. I think though the last year per se was exceptionally good, I think the traction in terms of the occupancy, in terms of the pricing, continues to remain very strong. Some of the companies have also carried out expansion, and that have a lot of positive rub-off across. So I think Indian hotels still has a 15-20% kind of an upside. Lemon Tree looks even more promising at 95, 96. Exceptionally a good performance. I think the numbers would be out maybe in a day or so. Looking exceptionally good. So I think surely we have a positive view across this space.
Well, what a fabulous year it's been, or patch it's been for anything which has got to do with consumption. Hemang Jani, is there merit in thinking that Indigo is no longer a pure aviation play which is exposed to the volatility of crude? Now Indigo is more like a consumer bet for next 2 or 3 years because India is growing, airports are getting connected, and air travel has now moved from luxury to necessity.
So within a sector which is so marred by controversies and issues surrounding companies going down under, Indigo definitely stands out when you look at their overall performance and the way that they have really gained the market share, particularly after we had this issue of Go Air and some issues with SpiceJet. I think surely it adds to the overall positioning of Indigo. I think Nikunj, from a overall perspective, definitely Indigo would be one stock where you would not have that comfort related issues. But what typically happens is that when the crude prices really shot up, let's say you touch around 100 or maybe a little more than that, that is when some of these companies, including Indigo, go through a little bit of a rough patch. So I think barring that risk overall, as a pure play, in this aviation and the high quality management, even the kind of selling which was there by one of the promoters, I think more or less that is getting absorbed in the market. So there is a lot of comfort with Indigo at this point of time.
Naresh, ONGC is something which we've discussed. Now that crude prices are decisively going higher, is there a trend in ONGC, GAIL, maybe Oil India?
So I've recommended ONGC a few days back, continue to remain extremely bullish on the stock. What is interesting for the stock is the stock has done nothing for the last almost from 2006 till date. So 2006, the stock used to be 140, 160. Even if we go back just a year back or 2 years back, you'll see the stock was at 150, 180 only. Now it is coming to on a dividend adjusted basis, it is crossing 2019 to 2022 highs. So it's a 5-year breakout, a shorter term breakout also done. And if you look at the stock is again something which is breaking out on 2 years, 3 years, 10 years. And overall, if you look at globally also, oil companies have done well. We do not have a direct correlation. A lot of oil companies in the US have done well. ONGC has given a breakout. Also, the fact is the stock has a relatively lower float also. It's something where now an interesting data point was ETFs owned 3.25% of the company and roughly 3% is the public float available. So the trend, if it starts, it could surprise on the upside just the way we've seen it in NTPC and Power Grid. So ONGC seems to be at a similar place where NTPC was, say, almost 6 to 12 months back. So out here, bullish on the stock. 170 to 180 is a good zone to buy. A stop loss would be 165. On the upside, say I would be looking at 220 to 250 over the next 6 to 12 months.
Kunal, autos have been in this dream patch. Based on the numbers, I think the upside fundamentally is looking difficult for me. But on the charts, are these stocks getting slightly lazy and slightly tardy?
Well, not all auto stocks are actually into a dream patch, Nikunj. Very few of them. So Tata Motors, of course, has done reasonably well. Escorts has done exceptionally well. Maruti has actually underperformed. Hero MotoCorp has not come back towards the life highs. Bajaj Auto had its fair share of coming back to the life highs, but then the stock has struggled, since then. Eicher Motors has had its fair share of rally and then a major correction. I think more than a 10 to 15% correction for Eicher Motors. Ashok Leyland is at 180, 82, I think, since the last 1.5 odd year. So there are very meager performances for most of the auto stocks. Only few of them have actually done very well. M&M, of course, is one of the standout performers since the previous year when the stock was at 750 odd levels to now 1500 plus mark where the stock was trading. So I think there are very few stocks which have actually done well. Now the catch is that whether these underperformers, the likes of Maruti, Hero MotoCorp to a large extent, Ashok Leyland, etc., whether these stocks make a comeback in the second round when the auto stocks get up for yet another upside, I think that's the more meatier part to look out for, because you can't be dependent on these erstwhile performers to keep on performing and then lead the charge, because at some point of time when fatigue comes into these stocks, there's bound to be a phase where the underperformers have to kick in. But if that also doesn't happen, that's where the auto stocks would start to correct.
I want to look at two stocks, Hemang Jani. And you want to guess this one, Hemang Jani, in 10 years, what's the return in Escorts? We talk about Bajaj Finance, we talk about Eicher. But do you want to guess, Hemang? In 10 years, Escorts, what could have been the return?
It should be more than 20%, Nikunj.
10 years? No, I'm talking about 10 years. I mean, you're talking about CAGR return.
Yeah, I'm talking about CAGR. 10 years absolute return, it would be maybe a 15x stock.
Look at that data. And in last 10 years, Escorts, oh my God, that OMG moment, I think, for me. A 80 rupee stock 10 years ago has gone to 2,500. Now, we don't stop here. Let's look at the 10-year return in Raymonds. So that's Escorts for you. And we talk about a lot of, HDFC Bank and Sundaram Finance being a multi-bagger. This company went public, I think, in 1994. Naresh and we were discussing yesterday. From 1994 to 2010, it did precious little. But between 2010 and 2023, last 10 years, actually, it has really been one of the most fantastic turnaround stories. Again, I mean, hats off to the great Rakesh Junwala. He was a big investor in Escorts just before the turn started. Raymonds. Last 10-year returns, again, exceptionally strong. It was between 180 to about 200 for almost 7 years. But in last 3 years, it has just done what could be called as a pole vault. And it has gone from 180 to 1880. Hemang Jani, now we are discussing stocks which have gone higher. If you have to take a bet on what could be the next big one or what are the next big ones, nobody knows what future installs. Randomness is always at play. But let's assign probability and possibility. 2 stocks.
Nikunj, are you asking me from this 2 names that you have discussed?
No,
which
that's
one,
history. I'm saying that's history. What we're discussing is history. Future will be different.
Correct.
So, Raymond is an unusual name. The company always existed, but it has turned out to be a great multi-bagger. Escorts, the brand was very well known, but last 10 years has been a great multi-bagger. So it's not that these businesses have got incubated in last 10 years. These are, Raymonds, I think, will be celebrating the 75th year of existence. And that could be the story for Escorts also, more than 35 years old. Which are the 2 companies which perhaps are existing companies, we know about them, but have potential to really pole vault in the next 5-6 years?
So Nikunj, I think IT has been out of flavor for a while, and some of these tech platforms which got listed 2 years back, we had Euphoria. They also went through their own sort of pain, but now things are looking much better. So I think Zomato could be one name where one can really take a maybe 2-year, 3-year kind of a view, because after all of that issues and performance related stuff and the acquisitions, I think things have settled down and we're hearing positive data points. Management has become far more cognizant of what the market really wants, and I think the numbers can really come through in a big way. So I think Zomato could and the technology could be one pocket where, because of the way things have panned out, there can be great opportunity and good amount of value there. So I think definitely one should look at that.
All right, Hemang, good to have you on board. Thanks so much for taking time out and joining in. Okay, what are the pre-open rates indicating after the Fitch news, after the fact that we had the global markets in the red and Asia as well following suit? Looks like it's going to be another day of perhaps range-bound trade. For now, 20-odd points off on the Nifty at 19,700, and for the Sensex, we're in the red, down about 180 points. Let's find out those mid-cap strategies then. And Naresh, what's on your radar today?
So continue to like Bandhan Bank, the stock has reversed back from that 220 mark. Good volumes over the last 2 weeks. A lot of blocks happened around this 220 mark. So a risk reward trade here. The stock has been the biggest underperformer in the whole banking space. A stop loss at 220 now, target price of 250.
Okay, so those are the top recommendations coming in from Naresh. Kunal, what about you?
So I'll go with Bata India as a bet from the mid-cap end. The stock has started to pick up pace. For the first 3 weeks of the month of July, the stock was absolutely sideways at the 1680 pivot for itself. In the last 1 or 2 weeks, the stock has tried to pick up decent momentum. So it's on the verge of a breakout. Would suggest a buy with 1800 as a short-term target and stop loss at 1730.
Okay, that's the take coming in from our chart. It's just quickly flagging out a couple of stocks in the pre-open before we move forward. BKG is higher by 5% in pre-open. Godrej aggregate numbers came just close to the last tick. That stock is still rising by around 3%. And then you have PVR Inox reacting positively, as well as Chola Finance. On the losing side, it's Redington India, which is showing a downtick of around 3.5%. But that's what the stock picture is looking like at this point of time. What are the news coming in from across the globe? Well, let's talk about the news Fatafat segment, and it was another heavy cloud for the ex-US President Donald Trump, who has now been criminally charged over efforts to overturn his 2020 election defeat. He's accused of 4 counts, including conspiracy to defraud the US, tampering with a witness, and conspiracy against the rights of citizens. Well, amid an ongoing shortage of the ADHD drug, Adderall, the pharma regulators in the US are now urging manufacturers to step up the production. According to the latest letter from the heads of the regulatory agencies, the manufacturers have been called upon to confirm if they are working to increase production to meet their allotted quota amount. Meta, that has begun the process to end access to news on Facebook and Instagram for all the users in Canada. The country's Online News Act requires platforms like Meta and Alphabet to pay news companies for their content on the platform. The Canadian government condemns Meta's move, calling it irresponsible.
Meantime, the spotlight is now on the Delhi Ordinance Bill. Opposition parties were quick to oppose it, calling it an undemocratic and unconstitutional bill. Meanwhile, discussions on the no-confidence motion will continue till the 10th of August. The Prime Minister will respond to the no-confidence motion. And meantime, let's also focus then on the ripples of the new violence which has made its way to the national capital. It's currently on high alert as the capital has witnessed 5 deaths and dozens of injuries in the latest clash. The Gurugram police has urged people not to pay heed to any rumors and several offices and they have also banned the sale of loose petrol and diesel. And in the world of sport, then, India has outshone West Indies, clinching the 3rd match ODI series with a thumping 2-1 victory. India has recorded their biggest ever away win against West Indies, beating the home team by a whopping 200 runs.
One of the sectors that's going to be in focus today is definitely cement, and Sanghi Industries and Ambuja will be in focus on account of that. But the entire sector is also in focus as the cement prices have marginally declined across the country in the month of July. The monsoons have led to a sluggish demand for the cement sector, and the demand is expected to remain subdued ahead as well. Let's go across to Sharad to get more insights into this cover from Dalal Street.
Well, yes, in focus we are having cement companies, and what we are getting from our channel checks is that the overall pan-India prices have actually fallen by ₹2 per bag as compared to what the numbers were there in the first quarter of FY24. Now, these are the numbers coming in for the month of July. And of course, the impact is coming in because of the monsoon. Apart from this, even the cement mills have indicated that there won't be any further price hikes coming in the month of August itself, and the dealers have stated that they're not expecting the pricing to sustain because of the monsoon and the upcoming festivities. Now, going ahead, of course, the demand is expected to be subdued. Second quarter is expected because of monsoon, the third quarter due to festivals, and the fourth quarter because of elections. Apart from this, also the northern and the western regions, they did see a price hike coming of ₹2 to ₹6 per bag, while for the regions of south, east and the central places in India, over there was a price cut ranging between ₹3 to ₹6 per kg. Apart from this, there was an important trend which we noticed, that the cost trends that has reversed, and the petcoke prices, they have actually gained 10% from the recent lows because of higher crude prices.
All right, let's find out what those index calls are as well from our chartists. What is it that they are flagging off as a strategy, given the fact that it has been nothing short of range bound for the equity markets? 250 points is the kind of range that we have been stuck in. So those index strategies as well should just come up for you on your screens. There you have it. It looks like it's tilting towards a hold, though Naresh says no trade on the Nifty.
Why should one not preempt the sell-off? Something what we were discussing yesterday. Global cues are not exactly strong. It's not reversal, it's a pause. Why should not one preempt a correction or a decline and then go short today or cut longs?
So, first evidence of longs will always, of trend change will always happen when the trend when the previous major support is broken. So we were discussing this yesterday and a couple of days back that 19,500, 520 is the major support or the previous lows for the index. We have been into this 500 point range for the Nifty. We are still at 90,750 mark for the index on yesterday's closing, which means that the first level of breakdown could happen once we break below that 9,500 mark. So it's always better to wait for that confirmation. 250 points is just 1.5% on the index. So, the moment we see that breakdown happen, that's the more apt time to try and cut your longs, try and initiate more shorts, as well as go short on the index. At this point of time, you can just lighten up the portfolio, reduce your longs, reduce the leverages. That's the better strategy rather than going short without the index actually confirming that there's a breakdown or a change of trend.
I want to particularly, Nilesh, the same question for you. Why should one not preempt a correction or a decline and perhaps raise some cash or even go short?
So the view is I'm not preempting it because as of now, the best way to ride this trend has been till the time it does not turn, do not preempt. Otherwise, there would have been multiple times in this move from 17,000 to 20,000 where you would have got trapped in the shorts. So wait for price action to confirm because the indices can go sideways much longer than one can look at it. So if you go short and the index does not go anywhere for 3 weeks, by the time the trend reverses down, one would be tired out of the position and miss out the actual downside take which is coming through. So currently the trend is up, stay with the trend, wait for price action to change your view.
It's very interesting that yesterday's blog deal talks about one large offload by KP Singh. Now normally, irrespective of what the situation was or even though it was in 2008 or 2020, DLF promoters never sold. So KP Singh yesterday sold 1.4 crore shares of DLF at about 504 rupees per share. That's what the bulk deal seems to be indicating, something which we were talking about it yesterday, but I just thought I'll bring it up. And second stock which I think is worth mentioning, and I don't track Thomax that well, but I see a sluggish growth. I see a sluggish growth at least at bottom line, and margins exactly have not moved the way I was anticipating, even though the decline in commodity prices are there. So let's see where Thermax is in the pre-open session. Now markets are saying something else. BKG, good numbers, should be up. Sula, well, they've got a excise duty notice. That does not mean they have to pay. I'm sure they're going to be going and appealing against it. But Sula is down 4%. And then Indigo and Titan ahead of numbers. Where are those two stocks settling? Let's look at it. Indigo ahead of numbers 2574. Flip it around with Titan and it is exactly at 3000. Meanwhile, Escort's margin expansion is a surprise. That's what all brokerages are saying. And it shot up post numbers. Numbers I think came after 2:30. It shot up post numbers and 2564 is where Escort's is. Anisha?
Oh, well, yes, a lot of stocks which are buzzing around, at least in the pre-open. And the other stock that actually reported numbers in the last hour was Godrej Aggregate. We had seen a huge spike at that time. And today as well, it seems like it's going to continue the move. But can't say the same about at the index level. There is a bit of sluggishness, which is very, very visible. We have hit that pause button. And for the last 7 to 8 trading sessions, 250-point range is what we are maintaining. Yesterday, at least, the good news was that we were maintaining 19,700. What pre-open rate is right now suggesting is that we might slip below that. Kunal, of course, has been saying till the time we maintain 19,500. The reversal hasn't happened and there's still a long way to go for there. But nonetheless, need to watch the market very, very closely. And global cues as well, Nikunj, this morning haven't been that supportive. The Asian markets are down anywhere between 0.5 to 1.5% on account of that US downgrade news. But let's see where we go from here on.
Well, pause does not mean reversal. Let's be very clear. And I'm not surprised with the pause at all because last couple of days, the triggers from the large cap stocks for the Nifty has not been there. But the breadth has not meaningfully declined, to be clear. The range on the Nifty from last 8 days is about 250 points. It's rarely you see this kind of a range. Small cap index was up for the third day on the trot now. Why? Okay. But markets have their own mind. And FIIs have been net sellers for the fourth consecutive session. So we are staring at a market where large cap stocks are looking rusty. Mid-cap stocks are just going up largely because of this rising tide. Small cap stocks rather going up largely because of this rising tide phenomenon. And as you walk into trade this morning, Ambuja numbers and there you go. 645 versus 1050. Revenue from operations 4730. These numbers looks like, I don't have the details, but I think they are a beat. Unlike a lot of other cement companies where you are anticipating a lot of advantage to kick in because of lower margins, lower coking coal, I think that was not true. But in case of Ambuja, looks like that advantage has kicked in. When we look at the fine print, markets will react to those numbers nevertheless. 10 seconds to go. It's a Wednesday morning. Nifty pre-open rates or the gift Nifty, all of them are indicating to a slight nick, and it could be anywhere between 50 to 75 points. The first rates, Wednesday morning on your screen. You're watching Financial Coverage Market live on ET now, and there you go. You've got a 70-point cut on the Nifty. You've got a 76-point cut on the Nifty now. The breadth is opening in favor of advances. The Sensex is down and the Bank Nifty is down by about 200 points. So on expected lines, it's a bit of a step back for benchmark indices. Now let's start addressing some newsmakers, and not too many newsmakers actually, but you want to start with auto companies, Maruti, Bajaj. Let's look at the auto space. You got Escorts, which is frankly is not going anywhere, but for the moment, Jaya Bharat Maruti, no, you want to look at Maruti. 9,066 for Maruti. Hero MotoCorp, they continue to lose market share. Bajaj, their exports are kicking in. For Eicher, no impact of the Harley Honda launch so far. And if one really looks at rest of the market, I mean, then the small ones, Anisha, BKG, you got Sirma, really small ones which are in use.
Oh well guys, but if you look at the market breadth, that's not that positive the way we have been seeing of late. And even if you look at the sectoral trends, most of the sectors are actually trading on the back foot. So there is a lot of pressure as far as the broader market is concerned as well. In terms of the stock specific action, as you mentioned, it's Thermax, which is higher by 5%, BKG is higher by 4%. Godrej Aggregate has had a stellar start, 6% higher on that one. PVR Inox as well continues to build on gains with a uptick of almost 2%. Triveni Turbine is starting the day with a gain of around 3%. On the losing side, however, you have Campus Activewear, where there was a block deal that was expected, seems to have happened now, because that stock is trading with a cut of around 6%. That's Campus Activewear, Reddington, and then Tata Chemicals, wherein our colleague just pointed out that there has been a price cut of almost 5%, which has been taken, is impacting that stock. And even Metro Brands did not enthuse the street with its performance at all. The margins were on the lower side, and that's the reason that stock is on the back foot. Which are the other stocks that you need to have on your radar? Let's look at Sanghi Industries, because the numbers of Ambuja Cements are out, but as of now we don't see much details in terms of any acquisition, but nonetheless that stock is holding up with a gain of around 5%. Sansera is the other one, and then of course the likes of Sirma SGS. These are some of the counters, and Sula as well, because that was showing a downtick of around 4% at start. So let's watch out for whether that's continuing to see that cut or not.
Okay, and within the broader markets as well, are you seeing that degree of outperformance when it comes to the small cap index? Not quite today. It's pretty much in line with the frontliners, or a little bit better off, albeit very marginally. Let's get in those first trades then. And Kunal, what's the screen indicating? Even Steven, when it comes to that market breadth at 19,655, what's the verdict?
Yeah, I think we'll wait out for the index to get into a breakdown mode. If it breaks below the 9,500 mark, till then we can expect that this consolidation may continue. In terms of individual stocks, Grasim was one of the stocks which I recommended earlier. The stock is now at 1850, 1860 plus levels, has done reasonably well, but it's now come back into some sort of an overbought nature on the chart. So would recommend to book profits for Grasim over the short-term traders, especially for stocks, for the traders who've been buying the stock at 1650 odd levels.
Okay, so Grasim book profits. Naresh, what's the first trade?
So continue to be bullish on NMDC. The stock is around the 115-16 mark, given a breakout, good volumes a day before. So keeping a stop loss at 113 and expecting a move towards 125, 130.